Good morning and welcome to Bazaar Morning Call. I am Anuj Singhal from the Noida studio, and joining me from Mumbai studio, of course, we have Prashant and Sonia as always. Prashant, Sonia, good morning. It's a very strong global setting, right? The Indian market, of course, has been strong regardless, but very strong global cues. So perhaps the market in for some more good times. In fact, if you see the data, the Nifty has outperformed the S&P 500 by 17% this year and within 4% of new high, while S&P 500 is 15% off. And the big question is, are we ready for life again above 18,000 mark? We'll find out. For starters, STX Nifty indicating that maybe we've already had a rally, so some consolidation may not hurt. Hi guys, good morning.
Hi Anuj, good morning. Prashant, good morning. And as someone was saying on Friday, right, ab ki baar 18,000. So perhaps that's what the market is also waiting for quite keenly. But as you said, I mean, Anuj, global risk on is definitely back, right? I mean, just look at what's happening in the global markets right now as we speak. The Japanese market is up about 310 points. You have the Dow, which was up 370 points. And there was a 3-week losing streak in the US, and that has now come to an end. The Dow gained almost 3% last week. Now, there's a lot of data to look forward to this week. There's the US CPI data that comes out on Thursday. Then come the 28th, there's the US Fed meeting. We all know that it's going to be the third consecutive rate hike by the US to the tune of almost 75 basis points. I think that's pretty much digested by the market, or at least that's the base case assumption. But what's happening back home in India? I mean, it's been large buying from FIs, over 2,100 crores is what you've seen. And not just the Nifty, which is above 17,800. The Bank Nifty closed at a 10-month high. The mid-cap index has now gained for 12 straight weeks. And there's more positive data coming out from the banks where the RBI, credit growth data shows that credit growth is at a 9-year high of 15.5%. In any case, we've seen stocks like ICICI Bank hitting new highs. But Anuj, that's the question, right? If this market has another leg up, which it seems like it does, will it be led largely by the financials because IT has taken a back seat? What does the texture of the market look like now?
Yes, Sonia, that's interesting. Actually, that's what I'm focusing on this morning. And my sense is, as you said, the banks have already done their bit. And it's something which the market has also priced in. I was making this point over the weekend as well about how a lot of buying has happened in the banks. Look, the market might just go through some kind of sector rotation. Because, when you get very close to lifetime high, this happens, that, you see a bit of sector rotation. IT, for example, I made this point on Friday as well, is perhaps in for a bit of a tactical rally. It may still be in a bear market, but it's showing signs of a double bottom and tactical buying. What is this tactical buying? Ahead of earnings season, expectation of Infosys buyback, and the fact that, even NASDAQ has shown signs of bounce back. In fact, the NASDAQ on Friday led the US market. So my sense is that for the near term, perhaps IT could play a bit of a catch-up. Last week you saw first signs of profit taking in the leadership pocket. FMCG, autos, these stocks did see some profit taking, though Bank Nifty, of course, still remained quite strong. Now, the Nifty IT is 27% off its 52-week highs. As I said, it's still in a bear market, but within that, perhaps it could have a bit of a tactical play. Over the medium term, though, absolutely no doubt about what the leadership pocket for the market is. It's the Bank Nifty. And if you look at the data this year, the Nifty is up 2.7%. The Bank Nifty is actually up 14%. That's a big outperformance. Why is Nifty still up 2.7%? Because the Nifty IT is down 26% year to date. X of Nifty IT, actually, the Indian market, most of the indices are trading almost at their lifetime highs, in certain cases above their previous October 2020 highs as well. So that's something which, for me is very heartening. And of course, as I was making this point, FIs have taken a bet on the Indian economy with the recent buying that you've seen in the domestic stocks. All of this subject to the Nifty holding that 20-day exponential moving average, it has done beautifully. Every time the market's giving you a dip, as long as 17,550, the 20-day exponential moving average is holding, the dip is likely to be bought. But Prashant, what do you have for us? Global market looking quite strong.
Anuj, hi, and wish you all the good food while you're in Delhi. So enjoy it. Yeah, absolutely, Anuj. I mean, things are looking up. I think you put it well when you said that US and global markets are looking better, but that was never a problem for the market here in India, right? The market was doing just fine irrespective. So for what it's worth, I mean, things in the US are also starting to look like maybe there is perhaps a bounce which is overdue. Could the S&P get to about, a little higher from where we are, 42, 4,300 kind of levels? It's possible. Let me explain. So last week, US equities bounced back after 3 straight weeks of falls, declines. The Nasdaq and the S&P 500 were up about 4% week on week. This even as fixed income continues to sell off. There is no real reprieve there, which I'll address a little later. What had happened is that markets over the last many weeks had gone through a series of hawkish events and meetings. There was Jackson Hole, there was that very strong jobs number, and of course there was Mr. Powell back again last week, where he said basically that he reiterated the need for rate hikes, adjustments in policy rates, etc. I'm not even talking about other central bank officials who've kind of spoken through over the last couple of weeks, reiterating all of this. So, all of this basically culminated into last week's ECB meeting, where the ECB took rates from 0% to 75 basis points, 75 basis point hike. And of course, there was the latest Fed Chair Powell's appearance as well. The question is, have we seen a bit of peak hawkishness in the near term? Markets, by the way, have also repriced central banks significantly through the last many weeks that I described. So it's not really clear where the next immediate hawkish impulse is going to come from. And because it's not clear where the next hawkish impulse is going to come from, what markets do is they look for, by implication, dovish risks. The most immediate one is, of course, the consumer price inflation number this week, which is on Tuesday. That will be closely watched. I think the consensus is expecting about 0.3, 0.4% increase. As far as core CPI is concerned, we'll see what the actual number is. Irrespective, a 75 basis point September hike is given. What the CPI report, if it does undershoot, will do is, what the market is pricing post-September, perhaps there may be a downshift in terms of market expectations there. Remember, post-September, the November meeting, the market is expecting, I think, about a 55 basis point hike, and then in December, another 20 basis point hike, 4% terminal rate by the end of this year. So maybe those things change. I don't think this report will change what they'll do on the 21st, which is the week after. But I think post this, there may be a little bit of downshift in terms of expectations. Of course, all this is up in the air. We'll need to see what the actual data points to. But, maybe in the near term, in the US also, we've reached a point of peak hawkishness. So that allows equities as an asset class to bounce a little bit from here. Sonia.
Absolutely. And the US inflation data, of course, it assumes a lot of importance, but the last data point also indicated that inflation is at a 40-year high, right? Yeah. So, and it's been 2 quarters of a fall in growth that we've seen in the US. So that's why this talks of recession. Yeah. I think the Fed has already taken that into consideration and decided what they're going to do in the 20th September meeting.